I can't get your eyes off from that one. Still locked down about almost 20%. In fact, let's hear out what the management also had to say after their numbers managed to miss on all counts. They also saw higher than expected inventory correction as well. Let's hear out a slice from that con call.
Now, from quarter two and half one perspective, I think there are two areas where we recognize that our outcomes have not sort of gone in line with our expectations. One, of course, is the impact of the sales returns and the inventory correction that has come through, which is higher than what we had imagined it to be. Because as we went into executing that, we clearly realized that there were pockets of sub-distributors or market credits which we had not taken into account. And as we also talked about the 4 or 5 key areas which are areas that we're focusing on, where we believe we need to rethink and some of the strategies and calibrate and evolve them in line with how we're seeing the landscape evolve.
Karan Taurani joins us now. Let's take this conversation forward with Hemang Jani. Hemang, does the stock deserve to fall by 20%? I mean, okay, numbers are bad, but they're not terrible.
So, hi Nikunj, I think the way the market has reacted, which means that there is a larger concern on the credibility of the numbers that the management has been giving, and more so after delivering a very good growth in the last 2 quarters. Typically for consumer companies, you would not see this kind of, major gaps, versus expectations. Yes, I can understand that versus a certain growth that the market is expecting, if there is a certain bit of disappointment, which has been the case with many, consumer companies in this quarter. But I think the way these numbers have been announced after giving the guidance, clearly there is a case of, credibility issue to my mind. And the business model, we can all attribute this to, the distribution channel, the disruption by Q-commerce, and many more things. But at the end of the day, the company was getting a certain valuation, and in the new scenario, current numbers and the outlook by the management, I think market will take, a lot of time to kind of digest this kind of an accident. So I would certainly think that there is a case for a significant de-rating as far as Honasa is concerned.
And what is your own sense? I mean, they say buy good businesses at weak prices, but is this good business which is going to be long-lasting? We were going through some of the brokerage notes. They said that, perhaps Honasa, if it were to reinvent itself, it's going to go into more sort of science-based products, more organic stuff. Do you think it can really reinvent itself and sort of disconnect from competition?
Yeah. Hi, Aisha. Morning. See, 2 things have happened in the market, I think, over the last one and a half year is that, the competitive intensity in the market has again come back. You are seeing many smaller brands in the BPC segment kind of take off because of the funding winter going away and, ample amount of liquidity and capital again, kind of coming back in the market. So many new brands start to get launched. A lot of within these brands or other existing brands, the portfolios have changed. So, towards skincare, there's a new category which is emerging, maybe hair serums and, differentiate kind of oils which are there. So, companies need to really innovate as far as, products are concerned, the portfolio is concerned, keeping the market in light. That's the first thing which is there in terms of disruption. Second disruption has happened in the form of quick commerce business, right? So quick commerce already is a very disruptive distribution mechanism. And I think, we are clearly seeing pressure wherein quick commerce players have also got like a huge cash pile on their books right now. And because of increased competitive intensity, we may see that in the near term, you will see higher amount of discounting which will somewhere put pressure on the players in the form of discounting or in terms of giving higher take rates to the quick commerce platforms, because bargaining power somewhere is more heavier on the platform side and not on the brand side somewhere, at least for now. So clearly these two things are very disruptive in nature. And I think we've seen that, in the results of Nykaa as well. So although Nykaa is kind of done a better performance because clearly they are an aggregator, they are a platform with multiple brands. So somewhere they have, kind of been able to maintain that double-digit growth rate, which has obviously come off, but they've been able to maintain that double-digit growth rate, which has been for them. But for brands, I think it's going to be tougher, as we see more product innovation, as we see more brands coming into the market, and as we see disruptive distribution mechanism emerging.
Yeah, Hemang, just a quick thought then on how one should really be reading into this for the long term, because Varun Alagh has actually said that this is a step back that they have taken in order to build stronger momentum for future breakthroughs. And what does one do with the stock right now, taking into account the commentary and the numbers?
So the way I look at this is that this is not like a normal consumer company, wherein there was a certain expectations of growth and the company actually delivered lower growth because of either urban, slowdown, etc., etc. This is a case of hyped expectations by the promoters, by the analyst community, and trying to justify unreasonable and very high valuations. And now, there is an effort to kind of do some sort of a salvage by saying that, the distribution model is not right. There is a quick commerce which is leading to some sort of a disruption. I think in a bull market, in an exuberance phase, you will find many promoters, investment bankers who are trying to push through certain themes and narratives. And this is just one such narrative. If you actually do a ground level check, I honestly don't know how many people, end up buying this kind of products at the ground level also, which requires some sort of a detailed check. So I definitely would avoid, doing any sort of, buying into this kind of companies. I think it's time to kind of do a much more filter, much more detailed work in terms of what's really happening, and then only take a call.
What is a fair price for Honasa? I mean, good business, bad business, everything has a price. Karan?
Yeah, I'm sorry.
No, I'm saying what at 300 rupees is the stock price of Honasa pricing in? The view what you're sharing with us perhaps is a reasonable view, but the stock has already gone down 20%.
Yeah, but in these kind of times where both the distribution mechanism and the competition is uncertain, I think the valuations can be challenged, right? So of course, after the fall, one would say that the valuations are low and unattractive. But unless we don't see any momentum pickup in terms of business or any respite in terms of increased profitability or any triggers therein, valuations are going to be tough, to move on from here on.
Right, Hemang, Karan, gentlemen, appreciate your time. Thank you for joining us. And
if you like this video, then like, share and subscribe to ET Now.